in the pits of the CME. Trent, I want to start with you. I mentioned, by the way, that commodities were getting hit as the dollar continued to increase dramatically. Is there a downside to the dollar getting as strong as it's been?
I mean, it remains to be seen. I think overall for the market, the strong dollar is going to equal the prevailing thought that it's better here in the U.S. than other places. I really don't see that narrative changing anytime soon. You just take a look at central banking policy. We have a QE program here getting ready to be wrapped up this month. We have other major economies essentially scaling up for another round. So, this is something that's not going to change, in my opinion. I don't think it's that. I think there's more benefit to this than not outside of the commodity sector. But, what we're seeing today here in the S&P, we're going to close near the highs of the day. This 4 to 6% type of move down, it's really been the blueprint over the last couple of years, and it's been proven a buy is the right thing to do if you get that type of a move down.
Well, Mike Chadwick doesn't see the benefit, at least as a reality. Mike, you feel that the Fed has propped this up. That's not a new concept. We've heard that before from some guests, but let me play devil's advocate here. So what? The fact is that in the last hour, for example, there are companies that are doing very well. We had GameStop, their sales of PlayStation and Xbox One up 70% from the last time these guys came out with new different kinds of gaming consoles. You think that's Fed related?
No, I don't think. Each company is different. I mean, I think some companies are killing it out there. They're doing really well. There's exponential revenue growth, earnings growth, as you've pointed out. But I think if you look at the market as a whole, the patient's been on morphine. It's been on QE. And as Trent pointed out, we're winding down now. So I think this is going to be an important month. It's our last month of QE. How is the patient going to behave moving forward? And as he also pointed out, foreign governments are just ramping up their QE programs to be even bigger. But the question we have to ask ourselves is this. Over the last few years, where would we be had QE not existed? Great question.
All right. Well, we're certainly going to find out soon enough. Mark, I just want to talk about the jobs data because, as I mentioned to Liz, it seemed to be in that sort of perfect zone between not too good, but good enough. And Anthony Scaramucci sent us an email earlier today. He said there's little to no wage growth in the data. Very important point for Anthony to make. Still, jobs have been added, and this is a net positive, but not positive enough to push the Fed into a move. A great environment for stocks and bonds. He was right today. Will he be right next week?
Well, Dave, I think it is a good point. It's kind of this Goldilocks scenario. It was a number for everybody today. 248,000 jobs is, a strong number. Certainly, the revisions to July and August are helpful as well. It keeps the average growth rate of jobs on a monthly basis this year well north of 200,000 per. But when you look inside the numbers and see something like flat month-over-month wage growth, still up 2% on a year-over-year basis, but flat month-over-month. Encouragingly, hours worked extended somewhat. The work week did.
Yep.
And so between that and the fact that we've had aggregate job growth collectively means wage growth collectively has expanded somewhat. So that's encouraging for the economy, but clearly, to your point, it does leave a little bit of dissatisfaction relative to not seeing that kind of wage growth that in combination with job growth would really be the elixir for a much better economic climate. And as a consequence, I think, again, the Fed waits to collect more data.
Let me then go back to Mike, because I'll tell you something. At this network, we're very much interested in either helping people maintain their wealth or grow their wealth or create wealth. We're not a day trading audience network. That does nobody any good. So where, if it is true, your perspective that we may start to really see how when the tide goes out, naked people really look, to quote Warren Buffett, where would you be putting your money? Are there different areas that you feel will do well no matter what?
That's a great question. And I'll tell you what I feel today is things are dangerous. Dangerous like I've never seen before. In fact, if you think about this conversation we're having, everything's revolving around Fed policy. People aren't talking about valuations. Valuations are high by any metric we can look at.
No. Let me just clarify. They are high for recent history, but historically they're lingering at what appears to be fully priced.
I think fully priced is being kind. So to your point, where do you put money? I tell people, listen, at these levels, you got to be very cautious. What I would suggest is to have some cash, and then when you deploy assets, be well diversified. I would especially avoid what I consider to be the very bubblicious areas, things like social media, biotech, small caps. These things are really high by any metric.
Well, the
there are
Fed's
some
warned.
things that are reasonable.
So you're with the Fed on that?
I like bubblicious better than high alpha. There's something about bubblicious I love. Trent, what about traders down at the CME? What do they see for the future of Fed moves as a result of what happened with the jobs numbers today?
Well, I mean, even though we're wrapping up the QE, and I think the jobs numbers today, there's certainly a mixed bag of information in there, but I think it was more good than bad, so to speak. And I think that's a narrative that we're seeing with the U.S. in general, as I mentioned earlier. The fact of the matter is things in the U.S. are better than a lot of other places. And if you look at what we saw with the recent weakness in the equity markets here, it was mostly attributed to weakness in foreign equity markets. You know, we'd have China down big in the overnight, and geopolitical risk. But at the end of the day, you know, today's report, I think, confirmed a lot of what many people were thinking, is that the U.S. is the best alternative right now for people seeking to return yield on their investments. So I'm not saying that things are perfect in the economy. I would agree with Mike. The Fed has certainly backstopped this entire move we've seen to the upside, but I don't see that going away. Even though we're wrapping up QE, I think they're going to be very clear in any future communication that if they need to, they will do whatever's necessary to not let what happened a few years ago happen again. So
Janet has been clear on that. Janet Yellen isn't going to change her policy.
Yeah.
And for that reason, I think the equities here in the U.S. is where you have to be if you're looking to get relative value over the other asset classes.
And guess what? Mark's got 3 of them. 3. You love EMC. You really like ConocoPhillips. You like Citigroup. I know with Conoco you've got a decent dividend there. But what do you look for when you're recommending stocks like this?
Well, valuation support would be one area, Liz. I mean, we're looking for sectors that look relatively attractive when compared to their other sector peers in the market at large. Tech represents one, as does financials and energy for that matter, particularly with the decline recently in oil prices. And again, dividends, where we can find them, are something that we think is going to be important for a lot of investors, not just those seeking income, but as a total return component to an overall investor portfolio. So the common to these 3 names is, again, sectors that have typically done well as Fed monetary policy shifts from accommodation and loosening to still highly accommodative but tightening monetary policy. That's still a ways off in our view, most likely third quarter of 2015 at the earliest, but nonetheless, in this transition period, those sectors stand to do the best.
Mark Lucchini, Mike Chadwick, great to see you, gentlemen. Have a wonderful weekend. Trent, we're not through with you. We're going to see you in a couple of minutes when the S&P futures close. Thanks, guys.
Let's get to JP Morgan. JP Morgan with the bombshell announcement that, yes, not only did it suffer a data breach, it was a massive data breach. It sent shares of most cybersecurity stocks higher.
So tell us what you think. Millions of people